So, Scott, tell us a little bit about yourself. And I love the idea of self storage, and real estate investing for me is just by far the best way to make a living. But tell us about yourself and how you became successfully unemployed.
You know what? You're right. For all the reasons we love real estate, there is no other investment on the planet where you can borrow money to buy it. Where if you do things right, it appreciates, and then also we can depreciate it. And then if you're in rental real estate, then you move somebody in and they pay down your basis and they pay it off for you, and then you sell it and you've got all the cash. It's there is no other investment out there like that. And so then if you can turn it into a business and become unemployed, then that's exactly what we did. I started out with single family houses, following the Carlton Sheets method. Bought his home
You
study
did. You
system.
were you were the one that bought the Carlton
I,
Street
I
method.
was the one. Yeah. I saw the late night infomercial and I was hooked. I mean, what more could you want? Sitting down on the beach and just collecting checks all day long. It looked like a good gig. Well, so I bought a single family house, rehabbed it, refinanced it, rented it out, doing the Burr method before it was called the Burr method, and bought two more. And then we bought more and more and ended up with about, we didn't have a large portfolio. We had about 78, 80 houses, and but didn't have the cash flow and the freedom like Carlton had talked about. And so I thought, well, we'll just double down, and economies of scale will fix this. And so then we got into multifamily. And even though there's property management companies and we had property managers, at the end of the day, it's a whole lot of tenants and toilets and trash to take care of. And so we had 400 of those, and then we had the 80 houses, and just thought, well, there still has to be a better way. Love real estate for all the reasons we just mentioned, but how do I get rid of the tenants and the toilets and the trash? And everybody would love real estate if it weren't for that. And so, as you look around the landscape and asset classes, and then, there's parking lots and then there's self-storage. Those are the only two basically that don't have tenants. And so not a lot of ways to be able to create value in a parking lot. And so self-storage made sense. And so I started looking into it, and a lot of the skill set transferred over from a commercial real estate standpoint, and underwriting and financing and multiple, units, transferred from my multifamily experience into self-storage, but yeah, eliminated the three T's. And so the more I looked into it, especially realizing that when somebody doesn't pay you, you can lock them out and then sell their stuff off after 90 days, and get repaid essentially for the back rent and late fees. And once we realized that, then yeah, we were off to the races. So bought my first self-storage facility with a partner because I didn't have experience and banks didn't want to take a chance on us. And we bought a large one to begin with. And my partner and I stepped into a large amount of equity and cash flow out of the gate. And so the rest is history, as they say. I've sold all the houses, all our apartments, and then just went full bore into self-storage, and paid my partner out of that facility, and then moved on my own, if you want to call it that. But now we have an organization, and we've got approaching 2.5 million square feet and 14,000 doors nationwide. And we are continuing to, in this economy right now that we're heading into, self-storage does so well during a recession, and we're gearing up to make a big splash and acquire more and develop more this year, while simultaneously selling off at the top of the market. So yeah, we love the biz.
Buying a house, a rental property, isn't hard at all. Like, in fact, anybody could do it. Everybody's going to buy their own house to live in. If you're going to do it to buy a rental property, it's not that hard at all either. You just make sure you find a house, you make sure you're going to make some money in passive income, and you buy the property. Seems like self storage is going to be a much bigger ball of wax. Like, how do we? I'm just trying to think of, how do we even get started doing it? What's the first step that we to get into investing in self storage? Is it learning how to do it first, or finding a property first?
The approach is the same. It's just there's more steps, and there's a few more nuances to it. Ultimately, when you're looking to buy a house, you want to find out what's it worth. Meaning, what's it worth right now? Am I overpaying, or am I getting a deal on this compared to the comps, the rest of the neighborhood? How much is it going to cost to fix it up? And then what is going to be the highest comp? What's going to be the value when I'm done with it? I mean, essentially, whether you're, trying to sell it off or rent it out, either way, you make your money on the buy, and you need to know how to value it so you don't overpay. Same thing goes for commercial real estate, including self-storage. The different steps and the components to it, there's a few more, because we're really looking at the value of the facility based upon the net operating income. And then we apply a ratio or a capitalization rate to determine the current value. And then, if we take a look at the underwriting, well, we can raise rents. It looks like we're 20% below the rest of the market. So we can raise rents on all 400 of these units. And so our income is now this, and we can reduce some expenses over here. So now our net operating income is this. And using the market capitalization rate, we can take this facility to this. And so that's our after repaired value calculation that we used to do in single family houses, although we do it based upon the income and expenses in commercial real estate. So longer process, there's an art and a science to the underwriting. And then also looking at the market, it doesn't help to say, well, it looks like, it's only 50% occupied. If I take it up to 90%, here's how much money I'll make. Well, that's fine in a market where everybody's at 90%, but what if all the competitors around, it's an oversupplied market and everybody's sitting at 60% occupancy? Well, you kind of blew it right out of the gate if you didn't bother to take a look at the rest of the market. So there's the two pieces. We do the underwriting and the valuation on the property differently, but the market is so important too, to see where we can take it, or our ability to take it where we think we can is dependent upon the market. So we've got to get really good at the art and science of both of those. Does that answer your question? Does that make sense?
It does. And it also brings up a ton more questions. So the first one that easily comes up, how do you find them? How do you make sure that you find because we could definitely, like the ratios and everything like that and running the numbers, we can definitely learn that. But you can't really learn driving around. Like, do you go to LoopNet, is it loop.net or whatever the website? Like, how do you find these properties?
So again, similar approach, but also very different. We the person who wins in real estate is the one who gets the marketing piece down. They got to beat everybody else to the punch, and that is it's an all out effort. So we've got roughly 10 or 11 ways that we utilize, mostly 4 or 5. But 11 different ways that we're utilizing to get out into the marketplace and find these deals before anybody else does. So it starts with the brokers who are our competitors. I mean, we're always trying to buy it before it gets to the broker, but we also have brokers on our team and we work with them. And the brokers that we work well with are the ones that bring us the deals before anybody else. The proverbial pocket listing or darn close to it. But that's because we never take a dime of their commission. They're going to get full. They know that we're going to give them a solid offer, and we have the ability to close, and we do what we say. So that's how we get brokers working for us. Simultaneously, we're doing the same things that they're doing and competing against them. And we're sending mailers out and marketing too, where they say, hey, I'm the king and the queen of self-storage in XYZ market. We're saying, hey, we're the kings and queens of self-storage, and you don't have to pay a broker to sell your property. Sell it to us. And so we hope to get to those folks before a broker will, and tell them, that they can get them more for the property, maybe sometimes to get the listing, and essentially maybe not doing as good a job as we would. But at the end of the day, the customer makes the decision. We just need to be both places. We need to cover both bases. And then, it is, we don't, probably the only thing we don't do, Dustin, is, we don't have a magnet on the side of my car that says I buy self-storage facilities and drive around town hoping that somebody's going to, call me. But you know what? When I'm out and about, especially if I'm in a market going to look at a facility, you bet, as part of my due diligence and my market analysis, I'm looking at the competition, and I'm not only looking at them, I'm walking in, open up the door, and creating a conversation with either the manager or hopefully the owner behind the counter, and letting them know what I'm there for. I'm doing a market study. And by the way, if you're ever interested in selling your facility, we're buying, or I know of people that may want to buy your facility, and gathering information. So we do pull on doors, but more of it is really a concentrated marketing effort of sending the mailers out and direct mail. And then following up, any direct mail campaign is only as good as the follow-up. So we do have people that are hammering the phones and hitting these people with mailers and phone calls just to check in with them, build a relationship, and hopefully when the time comes and they are ready to sell, that we're the ones that they call, or we happen to catch them at that time when they're considering it. So those are the 3 main. So brokers, sending our mailers out, following up, phone calls, and then just hitting the streets, any way possible to be able to get in contact with the owners, associations, self-storage associations in the state, and getting to know all the owners that are there and creating that relationship with them. There's a number of different ways, but those are the main ones. You'd be able to fill your funnel up if you're just doing those.
And a lot of people make the mistake of just doing one thing. Like, let's just call up a realtor and have them. No, that you're going to be, it's going to be hard to find a deal. Now, Scott, I think you might appreciate this. The reason why I started with finding the properties is that's what most people think of when they are doing investing. Like, I need to find it first. Well, that's, in my opinion, in my rental property investing business, finding the properties is like the last step. The first step would be building the business, making sure we can fund the property, making sure we can manage the properties, making sure that we're not going to be losing money. There's so many things that we need to do on the back end in building the business first. So talk to me about, whenever we do get a property, I want to start with managing it. How do we manage it and make sure we're not creating another job for ourselves?
I'm going to meet you in the middle there, Dustin. And just I don't want anybody to hear this incorrectly, because we tell people the exact same thing that you're saying, but we phrase it a little bit differently, because there's many folks that will think that, well, wait a minute, before I even start thinking about investing, I've got to have a logo to put on that mailer that Scott and Dustin talk about it. So
Yeah.
we're going to have a little mini forum with the moms at the bus stop and the kid, the
Oh
parents at the
yeah.
soccer, line, and we're going to get my logo down, and then the colors, and then we're going to test market this. So, I mean, you can go too far with that, but we also, to your point, we start with the exit in mind, and that is how am I going to sell this? When am I going to sell it? Who's going to want to buy it? Are there any issues with this? And so that's going to dictate where I'm going to go market to begin with. I need to be in a place where people, want to be able to invest. But the second of all, or somewhere near the top, as you just said, is management. Am I going to manage this? Is somebody else going to manage it? We have to have that piece figured out before we even get into it. With storage and commercial real estate, we buy multiple states away, and we can do that because we can hire third-party property management companies. But people that are starting out, I have a full-time job, I can't do this, or it's a smaller facility and it really can't, doesn't have the payroll to support a full-time person. It's going to be somebody part-time, and I'm going to pick up the slack. Can I do that? Do I have the bandwidth? And so figuring out that management piece. And then you don't, it is a little bit different with commercial real estate in that you don't have to have a bank that says, yeah, we'll do that all day long, because they'll never tell you that, because the success of getting a yes from the bank is dependent upon the deal you bring them. They're looking more to the property to repay that loan, the income that comes from that, versus you as your credit score and your ability, if a thing goes to heck in a handbasket, and coming after you to make up that balance and, dipping into your pockets. And so you identify those lenders, as you said, and say, find out who in that market where this facility is, or if it's in your backyard, your market, your current lenders that you're working with, or others, who like self-storage. And say, yeah, we love self-storage, and we've got programs, and we do loans on self-storage, and we've had very successful projects, and we're doing this, this, and this. So if you bring something to us, put it in front of us, we'll definitely take a look at it. In the meantime, how's your credit? Get your, make sure that you have your house in order, and have your PFS ready, your tax returns, and they'll tell you what you need to have to be able to put together a plan, a business plan, and then your loan package and your loan request. So those things need to happen, because you're right, in commercial real estate or a larger deal, once you go under contract, there's a whole lot that has to happen right away, and get through due diligence. Otherwise, it falls out of contract. And if you don't have a team in place, if you don't have those boxes checked, you can't go out and start to build your team once you go under contract for a facility, or you're going to lose it. It just won't happen. So, there's that balance between getting prepared, and first of all, really, figuring out, how you're going to evaluate this thing, and have somebody look over your shoulder if it's your first one, to make sure that you're not overpaying for this thing, and that you know what you're doing right out of the gate, because in the beginning, you don't know what you don't know. So having somebody come alongside of you, a mentor, or bringing in a partner in the beginning to march you through those steps. And then sometimes, they already have a team in place, and so you don't have to build it out. So that gives you a little extra boost of confidence, knowing if I put something under contract, I'm going to get across the finish line because my partner's been through this, and they bring some resources as well.
I think that there are three major things in any real estate investing. Number one, finding; number two, funding; and number three, managing it and making sure that you're running it well. If you have any one of those pieces missing and are not working out well, it's going to be rather hard to do that. So you also mentioned something that people need to definitely understand, that when you are getting mortgages for a regular single family home, super simple. Just make sure you have a W-2, make sure you could, send it over, your tax return for your job, send it over to the mortgage company. They'll verify that you can repay the mortgage, and it's easy. But getting a commercial loan is totally different, totally different. They even not just want to make sure that you have experience. That's number one. They want to make sure you have experience, that you're not going to lose them money, but also making sure you have adequate reserves. Like, you need to be able to pay for the mortgage, as well as at least maybe double that. Talk to us a little bit about the funding, the mortgage aspect, and these commercial loans. Like, it's not a regular 30-year fixed. It's probably 5 years. It's got different terms and all that sort of stuff. Talk to us about how we can make sure that we are set up well to buy a property with a mortgage.
Credit team and the underwriters, when you present a deal to the bank or any lender, they're going to do a global spread, which means they are going to look at your W-2 income and your credit score, and to see if you're credit worthy. That really speaks more to you as an individual than it does really your ability to repay, but it is a very good indicator of that. But then they're going to look at the project itself. And roughly what they're looking for, Dustin, is about 1.25 to 1.3 debt service coverage ratio. So the income is coming in, it's supporting the mortgage 1.3 times that. And so there is an overage to cover those reserves. Now, if it's a development project, you're going to borrow a little bit more for lease up reserves and, the carrying of the loan while it's under construction. So they'll build that into it so long as the project on the back end, once it begins cash flowing, hopefully it begins cash flowing in year 2 or 3 and not year 5 or 6. Otherwise, you won't get a loan. But they're going to take all of that into consideration and looking at the project that you borrowed enough actually to, have that runway to get up to that place. But then in terms of the global spread, they're also going to take a look at your other, if you've got other assets and other investments, are you buying the self-storage facility that's cash flowing to make up because, everything is leaking like a sieve over here and you're losing cash on this other, on the other portfolio that you have, your other assets. So they want to take a look to see the entire picture to make sure that you have the wherewithal going forward. And they're also going to look at your balance sheet to determine, what is your net worth. So if you're looking to borrow $1 million, is your net worth $1 million? If you had to liquidate everything, would they be able to get their claws into you? If they got nothing out of the property, would they be able to get some of that, recoup some of their money if you personally guarantee, and be able to, force you, unfortunately, to sell some of that off to, cover the cost of their loan. So there's all these factors, and every bank has, roughly the same percentages and ratios, but each one is a little bit different. The community banks, the credit unions, the savings and loans, and those are the folks that we like to work with the most because they'll look under the hood of your business. They're all about the relationship. They're looking at something long-term. They want to portfolio these loans. They want to keep them on their balance sheet because they know that self-storage does well during a recession. And they're not the ones that the larger lenders or the broker houses that are looking to package them up and then sell them off to Wall Street. So those are the folks that we look at. They look at things a little bit differently. And so there's never a second chance to make a first impression. And you should always put your best foot forward and make sure that you have a all-inclusive full package that explains your hero file on who you are, what you've done in the past, and then clear financials, and that you can deliver that in a very short time frame when they ask for it. Because once you go into contract, guess what? The next stop is the bank. And so you can't take another 30 days to assemble all that. Have your business plan in place. Make sure your financial house is in order before you go out and begin putting out offers.
Finding a property manager for a single family rental property, it's not necessarily hard. It's much easier to find a realtor. Realtors are a dime a dozen, but property managers much less. Maybe like if you could count of, all the different realtors, there's probably 10% could, total number would be actually a property manager. Not saying that a realtor would be a property manager, but there's so fewer property managers. I would assume, and I could be completely wrong, but there are even fewer property managers for self-storage. Like, are they easy to find? That seems like that's one component that we as investors, we need to make sure it's going to be working on a day-to-day basis. How do we make sure that we find a good property manager and hire the right ones instead of hiring the wrong ones that are going to be actually losing us money?
Well, I've been at this for 17 years, Dustin, and I didn't make the best decisions on the front end, and I still see a whole bunch of folks that are making bad decisions when they get into the business. And probably the number one is that self-storage, it doesn't take a lot of payroll. It doesn't take a lot of management. It's not like an apartment complex where somebody has to be there to take sales calls and walk people around to show them the apartments. We got metal boxes on concrete slabs. One is the same as the next and the next and the next. And people rent these things online, and they see what it looks like on the inside, and they're not going to be surprised by what they get. They're not shopping for school systems. They're not, does yours have a pool? And, they're not looking for any of that. They need a place to put their stuff that's clean and safe and secure, and they want to check it off their list of things to do because storage is demands based. It's not the same. It's completely different than where somebody is going to live and where they're going to commune. So from that standpoint, we don't have to have a manager selling people on stuff. And also it's just stuff. It's not people. So they don't have to be there to, handle all the work orders. There's no plumbing, there's no heating, there's no air conditioning, there's no paint, there's no maintenance, all those things that go wrong at a self-storage facility. And you don't have to write letters to somebody for parking on the grass and fighting with the neighbors and having the stereo up too loud on their dog that's pooping on the sidewalk. So in apartments, the rule of thumb used to be 10 hours a week for every 100 units. Where storage, it's 10 hours a week for every 400 units. So it takes a long time before you get to the place where you need to have a full-time person, on site. And technology, we can rent a unit by way of a kiosk or by way of a smartphone now. So we don't have to have somebody on site anymore with keypad access. Everybody can get into their units. So that's the first piece. But then also the mistake that I think people make is, I've seen over and over again, is that they realize that they can't afford a lot of payroll, and so they're going to get away as cheaply as possible. So they buy $1 million asset, $2 million asset, and then they hire the gal that cuts their hair to manage it because she's nice and friendly, and I want her to do better in life. And it's just like, you know what? Just because it's your self-storage facility or a piece of real estate, just step back and have anybody advise you on this. Would you put your hairstylist in charge of $1 million of your stock portfolio or anything else? Well, of course not. So, but yet people do this over and over because it's just like, oh, 15, 20, $25 an hour. I can get people to work. To sit in the office and just take phone calls and write up paperwork. But that is a caretaker, and that's not what we're looking for. And that's not what you should look for at your facility or any commercial piece of real estate. That the person behind the counter, they're on the front line, and their sole purpose is to drive the NOI up. That means that they're reducing expenses at all costs. And every single day they're looking to increase their income at all costs. And we incentivize them and give them pay commensurate to that, and bonuses and commissions to drive the performance. People that usually, and no offense to anybody that cuts hair, it could be the person at Walmart or anything else, but clock watchers that are trading hours for dollars, those aren't the people that you want to have in charge of your $1 million, $2 million, $5 million asset that are going to drive the performance of it and ultimately make it either succeed or fail. Depending upon the size of the facility, you're going to be hiring, if it's a smaller facility, you're going to be hiring them on your own. Larger facilities, you hire a management company, and then it's a matter of vetting those, which is much easier. And they handle all the rest of that. If you've got a facility that's 200, 150 units, 200, less than that, then you are going to be hiring an individual, and you're going to be overseeing that person. So although we talk about service related type roles, we want the folks that are used to retail hours and that are in a sales role with commissions in a retail sales position. But they may be at a manager's level. They may have been running or in charge of a department, or at a restaurant where they were the sales manager, or catering at a hotel. Some of those folks that were in the real estate industry, and they decided they wanted to have more flexible hours and not as many hours. They work very well as well. But it's somebody who is driven by performance. They have to be good at sales, because they have to be, they have to take care of these people that come into the office. We are a demands-based business, and when people come into our office, we talk about the D's in our business. Death, divorce, bankruptcy, and just all kinds of issues that necessitate a need for storage. And so when people come into our office, their hair's on fire. Usually there's something that's gone on. Somebody died and they have to settle their estate. Somebody got a divorce. Somebody's getting separated. Somebody lost their job and now they're downsizing and they're moving back home. And so there's lots of demands that are kind of chaotic, and people are stressed when they come in. And so somebody needs to take care of them and give them what they need, have a needs assessment based, mentality about them, and then just be able to care for them and do what it takes to, make sure that they're taken care of. And if you can't, then the person has to have the foresight to be able to send them over to our competition. And then, hopefully they will reciprocate and send it back to us if you create that relationship with your competition. So it takes a little higher caliber of a person with the sales mentality and a caring nature to run that facility and treat it like their own.
Do you just put it like an ad, Facebook Marketplace, or like Craigslist, or in order to find the right people? It says 150 unit, smaller one. You just got to go to the normal spots to find employees.
We do referral basis, and of course, now I've never done this, but I know some other folks have. But they may go and try to poach from the other facilities around town and make a better offer to do that. And literally, I've never done that. I would never do that to my competition. But so we put on the usual places. Referral basis is good. But probably the first step, Dustin, to making sure that you get the right person is, again, we don't want somebody who's just spraying and praying and throwing resumes out there to try to get an additional $1 an hour at some place. We'll give them a little homework assignment that's buried within the application process. And if they don't do it, then, they're not our person. And we'll know in the first 5 minutes when we ask them if they did their homework assignment, or did they do this? If they haven't, then we move on to the next. And so, we do a little bit of vetting, and some of our higher levels, larger facilities that require a bigger skill set, and they're working with U-Haul customers and working with U-Haul corporate. And when we have truck rentals and we have boats and RVs and a concierge service, we're taking care of people's $1 million assets, that are in our multi-million-dollar asset. Those folks, we go through a predictive index, and we do a background assessment and making sure that, their core values are in alignment with ours, and they have a higher level of capabilities, and they're high capacity in several other areas to be able to handle some of those other, additional and higher level responsibilities. But it all starts in the normal places, and hopefully referral, to answer your question.
Yeah, I found people who are, because it's a little bit different nuance with rental properties. You have the property managers are more protecting the properties. At least, people, tenants come to you pretty easily. But when you're having a self storage, you also need to be a salesman. You need to be able to get people to want to go there. And so I could definitely see that. Now we have finding the properties as well as funding the properties. It seems like it's going to have a large down payment. Is that like 20%? What's the normal terms for a mortgage?
So in terms of how we structure the financial end of this, or what we call the capital stack, there's 100 ways from Sunday of putting together a deal, and it's no different in commercial. As a matter of fact, we got a few more tools in our toolbox that we can draw upon. So traditional, real estate transaction in commercial, not a lot different than a single family house, if you will. The banks are still looking for, if it's a development project, they may go up to 65% loan to cost, what it takes to build it. And an acquisition in an existing facility go up to 75, 80% loan to value based upon the historical financials. And then it's up to you to come up with, the cash, the down payment. Well, if it's $1 million, that may be a stretch for some folks. If it's $10 million, it's going to be a stretch for just about anybody. And so then comes mezzanine lending, where there's other lenders that will come in on top of the senior debt, and they'll come into a mezzanine or a second position. Their rates are 2 to 3 percentage points above the bank rates. They're going to charge more fees. And that's because they're in a riskier position, because they're in second position if everything goes to heck in a handbasket. And they're in for a short term usually, and then out. But they'll bridge that gap and go maybe another 10% on top. They're not going to go all the way to the end. You're still going to have some cash in it, but the way that we've grown, and most people do, is by way of raising private equity. So whether you start a fund and raise capital to deploy in different projects, or just take the facilities down 100% with the funds from the fund, that's a way of doing it. We have a fund, and we layer those funds on top of bank debt that bridges that gap for us, and we have a small amount of money into our projects. We also do single asset, single entity, meaning one facility where we do a syndication, and we bring in multiple investors at $50,000 or $100,000 minimum. And if it's a $10 million project and we have to bring $2.5 million, then we're raising it from our equity partners who have been working with us and following us for a number of years, and they'll invest 50 to 100,000 a piece and some more. And that's how we finish out the capital stack, or the equity portion, and we come to the closing table with that. There's a number of other ways, without getting too detailed, or 401 level, doing joint ventures with developers, joint ventures with just about anybody else, and putting together multiple partners on the general partner side. And just, I don't want to say piecemealing, but there's resources that people bring to the table to put a deal together that isn't just money and balance sheet, but it has to do with the resources in terms of their development acumen, their management acumen, and then maybe owners of some of these companies that all put together their resources into a deal, and everybody brings a little bit of cash to the table, and maybe some private equity too. And that's how, as long as everybody gets the returns that they're looking for from what we project on the back end, then that's a good way of putting these deals together. So again, many and multiple ways of doing it, but I don't want anybody to hear that on their first deal that the only way to do this is to buy a $1 million piece of commercial real estate or a self-storage facility, that you have to have 250 grand, because that is not true. Several of our students that we teach, they can buy $1 million property and they've got $10,000-$15,000 into it, and they use that from a self-directed IRA from somewhere. So there's lots of ways to get into this. I got into the business when I was broke and my credit was shot by way of my partner. And so don't let any of that discourage you and think you have to pay your dues before you get into commercial real estate, because it's not true.
Man, I love real estate. There's so many different ways. In fact, just before this interview with you, I had somebody that came on talking about flipping, but not necessarily flipping internal, but like wholesaling, flipping, hard money lending. There's so many different ways to make money in real estate investing. It's so amazing. I love single family homes, but and talking to you, I'm like, man, I really want to get into self storage. This is something I want to do as well. And this is great. Now, Scott, I'm going to be on your podcast. So talk to us about how people can find you, listen to your podcast and learn more about self-storage.
Yeah, well, it's real easy. Selfstorageinvesting.com. That is the place to find all things self-storage, and where you find me as well. And we've been at this for a number of years. We've got a lot of tools and free resources for folks. We've always been of the mindset that if we continue to put good education and content out there in the marketplace, when the tide rises, it takes all boats with it. And I've seen that happen. It's not just a cliche. And the more that we can educate even our competition, if there's folks out there that don't know what they're doing, and you've seen that, you and I have both seen this, Dustin, on the housing side, a whole bunch of folks that they don't know what they're doing. They come into the auctions or they start bidding up the price of a house, and they're just like, I know there's no way that they're going to make money on that if they're paying this for it, no matter how good they think they are or how low they think they're going to be able to rehab it for. It doesn't work, and then it makes it bad for everybody. And so that's been our mission from day one. So there's all kinds of free resources and ways to be able to get better in the business, and our investments to invest passively with us are up there. And yeah, just all kinds of content to get you all learned up on the business of self storage.
Love it. Man, Scott, thank you so much for being on the show. I really appreciate you giving us so much great insights as well.
My pleasure, Dustin. Looking forward to having you on ours as well. And anytime you or your clients have a question about self storage, that's what we're here for. So we are the company that gives back, and love to be able to help anybody and everybody that wants to get into this incredible business.